Hi, I'm Christine Benz from Morningstar.com. How will rising interest rates affect investors and the markets in the years ahead? Joining me to discuss that topic is Joe Davis. He is the Global Chief Economist and Global Head of Vanguard's Investment Strategy Group. Joe, thank you so much for being here.
Thanks for having me, Christine.
Joe, Vanguard has had a fairly sort of moderate outlook for interest rates, and I think it's safe to say you've been largely correct that the Fed has moved with a pretty deliberate pace. Would you say that your view, say 2 years ago, has kind of played out as you expected?
Generally, and I think it's fair to separate, Christine, our outlook for short-term interest rates influenced by the Federal Reserve with long-term interest rates. So 2 years ago, we thought the Federal Reserve would continue on their very gradual tightening path, that they would lower their long-term expectations for interest rates, which at the time were elevated closer to 4.5%. We thought they would lower their long-term expectations at the same time, given what we anticipated, or at least hoped for, is more tightness in the labor market, that we would see them continue on their gradual pace. That's generally come to fruition. And so we continue to expect the Federal Reserve to raise rates to roughly 3%.
When?
So every quarter through the middle of 2019. The one thing we have changed, though, we had a pause. Going into the year, we actually had a pause when the Federal Reserve would reach 2%. We thought that they would separate getting above the rate of core inflation, which is roughly 2%, with seeing how the economy's doing, and then proceed in a phase 2 approach. We revised that, and that's not what is going to happen. The Federal Reserve's been clear as well. So we still see the Fed effectively doing a soft landing, which if one's going to be critical of our forecast, it would be that that's really fairly unprecedented. History has generally shown that the Federal Reserve raises rates further than the bond market expects once it's in a tightening mode, and usually only stops until effectively something has broken. We think the two things that give some solace to our outlook. One is by 2019, the economy, although very solid, will start to show some weakness from the deceleration of fiscal policy. And the second one is that we don't see core inflation really rising materially above or below 2%. If core inflation continues to rise, then our forecast is wrong, and the Federal Reserve will raise rates even more than the bond market's expecting.
Okay, so that was my question about inflation. It sounds like you aren't nervous. There has been some hand-wringing recently.
Yeah, we are. I mean, I think so. One of our themes going into the year, however, was that there was risk to the status quo, which means we're never going to see any bout of inflation. We said, well, let's be careful. We're going to have periods where the market is ultra sensitized to any sort of looks like a breakout in either wages or inflation. And I still think we're still going to see another period with which that may lead to some market volatility. We saw it in February, but at the end of the day, when you smooth out that volatility, we still see core inflation slightly above and then coming back to 2% for a number of reasons. However, we do see wage inflation, importantly, rising more higher, which would be good. But I think it's important. The one risk of the bond market and even the Federal Reserve is we separate our outlook for wage inflation different from core inflation. Okay. Some people put those two together. There is the risk that the Federal Reserve could over-tighten because they see wage inflation rising, let's say in 2019, 2020, assuming that it will bleed into higher core inflation. Those two, in our mind, statistically are separate, but that's the risk which would, I think, increase the odds of a recession in the 2020. Again, the Federal Reserve is really smart. I don't think they will make that policy error, but that's something we debate internally a lot.
Okay. I want to talk about how investors should approach this environment, because there has been a lot of concern. We've seen bond prices drop a little bit. Some investors have had principal losses in their bond funds, and I've talked to investors who have said, you know what, I don't need this volatility with my safe assets. I'm just going to hunker down in cash. What do you say to investors who are trying to figure out the safe parts of their portfolio in an era of rising yields?
Yeah, and just personally, that's not something I do. I mean, I have those same conversations with my friends and family. I would say, importantly, cash is a savings vehicle. So if one is a long-term investor, it's hard to make any case, investment or otherwise, that cash should have a role in that portfolio. You're going to lose out over long periods of time to inflation, so you're not going to break even in that sense. Yes, with fixed income, you're going to have some of this rising rate volatility. However, there's a much more volatile asset class out there in the world. It's called equities. And there's more risk in the equity market today than the fixed income market. So we still view for most investors, that fixed income, high quality fixed income as a more of a ballast and bedrock to volatility in a diversified portfolio. So that's still our message in rising rate. And then for conservative investors, I think regardless of whether or not the Federal Reserve is raising rates or not, you can always think about shorter duration portfolios because that's where you'll have the greater, quicker interest rate reset. You just have less duration or interest rate exposure in the portfolio. But I wouldn't, for long-term investors, I wouldn't be introducing a Federal Reserve outlook for reasons why they should be considering changes in their fixed income portfolio.
Okay, I want to talk about equities, though. You touched on them because equities are not immune to changes in interest rates, specifically some sectors like utilities and real estate. So let's talk about that. What implications you think the current interest rate environment might have for people's equity portfolios?
Well, we even went into the year, Christine, fairly guarded on the outlook because of valuations. Now we think the U.S. stock market, which has had continued strong run, higher than we would have expected this year. I continue to say it should be a somewhat lower return environment, and it seems like the stock market keeps laughing at that. But valuations are fairly expensive. It's not the stock market is not a bubble because valuations should be higher today because of the lower interest rate environment. But there's going to be a time with which valuations will matter, and so we are not very bearish on the stock market. But I think it's unreasonable to expect this continued performance for a long period of time. So it's not an exciting message. It's not surprised though the market. Again, to say we do not foresee a bear market imminent because to see that we would need to be suggesting that a recession risk is elevated. Monetary policy is still accommodative. It will become restrictive next year, modestly so, and the fundamentals in the economy are fairly strong. So that is, I think, offsetting valuations. But over the next 5 years, it is highly likely that the returns will be lower than they have been in the past, just given the prices that the market is already discounting going forward. And that's really just a U.S. phenomenon because in overseas markets, valuations aren't nearly as stretched.
Okay, Joe, always great to hear your insights. Thank you so much for joining me.
Thank you.
Thanks for watching. I'm Christine Benz for Morningstar.com.